The woman who ran the United States Treasury for 4 years just issued the most terrifying warning about American debt that I have ever heard. Janet Yellen stood before the American Economic Association on January 5th, 2026, and compared what is happening to America right now to the fall of the Roman Empire. She said, "The preconditions for fiscal dominance are clearly strengthening." Those words should send chills down the spine of every American who owns a house, who has a retirement account, or who hopes to ever collect Social Security, because fiscal dominance is the technical term for when a government's debt becomes so massive that the entire economy becomes hostage to it. When the Federal Reserve can no longer fight inflation because raising interest rates would bankrupt the country. When the only options left are default, hyperinflation, or economic collapse. And according to Yellen and a panel of the most respected economists in America, we are entering that zone right now. Quick clarification, I don't post real-time confirmations or short macro updates on YouTube because long-form analysis takes time. For viewers who actively track these developments, I maintain an official WhatsApp channel for brief updates and data points. The link is in the description. Let me give you the number that explains everything. $38 trillion. That is how much debt the United States government owes as of January 2026. To put that in perspective, the entire United States economy produces about $32 trillion worth of goods and services in a year. That means our debt is now 120% of our gross domestic product. We owe more than our entire economy produces, and it is getting worse every single day. Here is the number that should terrify you even more. $1 trillion. That is how much the United States government now pays every year just in interest on that debt. Not paying down the debt, not funding programs, just paying interest. In 2020, that number was $345 billion. In 6 years, it has nearly tripled. By 2035, it will reach $1.8 trillion per year. We are now spending more on interest than we spend on Medicare, more than we spend on national defense, more than we spend on education, transportation, veterans benefits, and food stamps combined. Interest on the debt is now the second largest item in the entire federal budget behind only Social Security. Think about what that means. Every dollar we pay in interest is a dollar we cannot spend on roads, bridges, schools, hospitals, or defense. It is a dollar that goes to bondholders, many of them foreign governments instead of American citizens. And here's the trap. The more we pay in interest, the more we have to borrow to cover the interest payments, which means more debt, which means more interest. It is a death spiral, and we are already in it. Janet Yellen used a powerful analogy to explain what is happening. Imagine the economy is a car. She said the Treasury Department is the driver controlling spending. The Federal Reserve is the brake controlling inflation by raising or lowering interest rates. Now imagine that car is towing a $38 trillion trailer. The trailer is so heavy that if the Fed hits the brakes too hard by raising interest rates, the brake pads explode, because every time interest rates go up, the government's interest payments go up too. At $38 trillion, even a small rate increase means tens of billions of dollars in additional costs. So what happens? The Fed is forced to take its foot off the brake even when the car is speeding toward the cliff of inflation, because crashing the brakes would cause an even worse disaster. That is fiscal dominance. The debt becomes so large that it controls monetary policy instead of the other way around. The Fed loses its ability to fight inflation. Inflation becomes the only way to deal with the debt by making it worth less in real terms. Eric Leeper is a professor at the University of Virginia and a former Federal Reserve economist. He told Fortune magazine that when Yellen utters that phrase that we might be seeing signs of fiscal dominance, she was kind of part of it. He pointed out that as Treasury Secretary, Yellen called on Congress to go big during the pandemic. And at the same time, she said, "Do not worry, the Fed has the tools to control inflation." Leeper said that shows she does not really understand what fiscal dominance is. The Fed only has the tools if we are not in a fiscal dominant world, and increasingly we are. Leeper contrasted today with the early 1980s when Paul Volcker raised interest rates to nearly 20% to crush inflation. It worked, but here's why it worked. Back then, the national debt was only 25% of GDP. Because the debt was low, it took a long time for interest payments to affect the budget. The government had time to adjust. Today, the debt is 120% of GDP. The impact of rate hikes is instantaneous. If the Fed raised rates to Volcker levels today, the interest payments would immediately consume the entire federal budget. It is mathematically impossible. Leeper described what he calls the Hamilton norm. For most of American history, the expectation was that any debt issued today would eventually be paid off by future tax surpluses. Alexander Hamilton established this principle when he assumed state debts after the Revolutionary War and then ran surpluses to pay them down. That norm Leeper said died in 2020. When Trump put his name on the stimulus checks and Biden added trillions more, neither administration even pretended they would ever pay it back. The debt was treated as a permanent gift to the economy, not a loan to be repaid. When the public stops viewing government debt as an IOU for future taxes and starts viewing it as a permanent gift, Leeper warned the Federal Reserve loses its grip. If people do not believe taxes will ever rise to pay off the $38 trillion, they spend their gift today driving up prices. In this world, inflation is not a bug. It is a feature. It is how the crisis gets resolved whether we want it or not. The Congressional Budget Office has run the numbers and they are horrifying. Under current law, the national debt will reach $50 trillion within 10 years. That would be 118% of GDP. But that projection was made before the One Big Beautiful Bill Act was signed into law in July 2025. That law added $3.4 trillion to deficits over the next decade. If its temporary provisions are made permanent, it will add $5.5 trillion. The debt is now on track to reach 150% of GDP within 30 years. That is the trajectory toward Argentina, toward Greece, toward the Weimar Republic. And the situation just got worse. On January 22, 2026, the Committee for a Responsible Federal Budget released a report titled, "What Would a Fiscal Crisis Look Like?" It identified 6 distinct types of crises that America could face if the debt continues on its current path. Let me walk you through each one because every American needs to understand what is coming. The first is a financial crisis. Reduced confidence in Treasury markets could lead to a spike in interest rates, panic among traders, devaluation of assets, freezing of credit, and failure of major financial institutions. The report compared this to 2007, when the housing crisis triggered a global financial meltdown. Output shrank 4%. Unemployment hit 10%. Housing values dropped 25%. Hundreds of financial institutions failed. The economy took years to recover. Now imagine that happening because investors lose faith in Treasury bonds, the same bonds that are supposed to be the safest investment in the world. The second is an inflation crisis. To avoid default, the Federal Reserve might be forced to monetize the debt by printing money to buy Treasury bonds. This is exactly what happened in Venezuela in the 2010s, in Zimbabwe, in the 2000s in Argentina, repeatedly since the 1960s, and in the Weimar Republic in the 1920s. The result is hyperinflation, where prices clear's throat double every few months and savings become worthless overnight. Ray Dalio, the billionaire hedge fund manager, has been warning consistently from Davos this week about the risks of the United States monetizing its debt. He calls it an economic heart attack. The third is an austerity crisis. If market confidence collapses, lawmakers might be forced to enact massive spending cuts and tax hikes immediately to restore faith in government finances. The report estimated that a fiscal contraction equivalent to 5% of GDP could turn modest growth into a 3% economic shrinkage. That would be the deepest recession since the Great Depression. Unemployment would spike, businesses would close, a self-reinforcing depression would set in. This is exactly what happened to Greece in the 2010s when emergency austerity measures caused the economy to shrink by 25%. The fourth is a currency crisis. The dollar could face sudden and significant depreciation in response to fiscal stress. Foreign investors would flee. Import prices would surge. The global financial system built on dollar dominance would destabilize. America's ability to import goods and project power would collapse. Every American traveling abroad would see their purchasing power evaporate. Every business that imports products would see costs explode. The fifth is a default crisis. Although considered very unlikely by the report, if it happened, it would be catastrophic. The United States currently owes $31 trillion to the public. A default would freeze global credit markets, crash stock markets, and plunge the world into deep recession. Countries like Argentina, Russia, and Greece have defaulted on their debts. The aftermath takes decades to overcome. For America, whose bonds are the foundation of the global financial system, a default would be an order of magnitude worse. The sixth, and perhaps most insidious, is a gradual crisis. No acute event occurs. Instead, high debt slowly crowds out investment year after year. Growth stagnates. Living standards erode. The report pointed to Japan, which has maintained extremely high debt levels for decades without acute crisis, but whose economy has only grown 10% total over the past 20 years. That is 0.5% per year. An entire generation of Japanese young people has never known economic prosperity. The report noted that Western European economies like France and the United Kingdom are already showing signs of this gradual crisis, with slow growth and inflexible fiscal policy. The report concluded with a warning that should haunt every policymaker. With debt at 100% of GDP, the United States has less fiscal space than at any time in history in case of another war, pandemic, or recession. We used to be able to borrow our way out of emergencies. That option is disappearing. The next major crisis will find America with its credit card already maxed out. But wait, there is more. The federal government has already borrowed $61 billion in the first 3 months of fiscal year 2026. That is despite tariffs that have brought in tens of billions in additional revenue. Why? Because spending keeps rising faster than revenue. The Congressional Budget Office projected a $1.7 trillion deficit for fiscal year 2026. That is 5.5% of GDP in peacetime with no recession. This is not sustainable. Meanwhile, Trump has vowed to boost defense spending to $1.5 trillion per year, up from $1 trillion. That is a 50% increase in military spending when we are already drowning in debt. And the Supreme Court could strike down his global tariffs at any moment, eliminating one of the few new revenue sources the government has found. In this year's tax season, we'll see a surge of refunds because of the tax cuts in the One Big Beautiful Bill Act. Revenue is about to drop while spending keeps rising. Let me tell you about the One Big Beautiful Bill Act, because it shows how unserious Washington is about this crisis. The law was signed on July 4th, 2025. It made permanent the 2017 tax cuts that were set to expire. It created new tax deductions for tips over time and senior income. It raised the debt ceiling by $5 trillion, and it increased spending on defense and border enforcement by hundreds of billions of dollars. The Congressional Budget Office estimated it will add $3.44 trillion to deficits over 10 years. But that is before interest costs. With interest, it will add more than $4 trillion. If the temporary provisions are made permanent, it will add $5.5 trillion. This single law will add more to the national debt than the CHIPS Act, the Bipartisan Infrastructure Law, the American Rescue Plan, and the CARES Act combined. The law also cut Medicaid by 12%, the largest cut in the program's history. It expanded work requirements for food stamps. 10 million Americans will lose health insurance over the next decade, according to the CBO. Rural hospitals are already announcing closures. And here's the kicker. The CBO found that the top 10% of earners will see their incomes rise by 2.7%, while the bottom 10% will see their incomes fall by 3.1%. The rich get richer and everyone else pays for it. But the politicians are not worried. House Speaker Mike Johnson predicted that voters will reward Republicans for the bill in the midterm elections. No concerns at all. He said, "We are that confident. This is the level of denial we are dealing with. The country is heading toward fiscal catastrophe, and the people in charge think they will be rewarded for making it worse." Heather Long, the chief economist for Navy Federal Credit Union, told Fortune that the bond market is the new king in the United States. She said, "And for most nations, crossing the 120% debt to GDP threshold is a game-changer that gives bond investors significant influence over the rest of the economy. That influence is felt by households through higher borrowing costs for mortgages and car loans, which are increasingly independent of what the Fed actually decides. When institutional reports like this come out, I usually flag them with a short note on the WhatsApp channel because full breakdowns come later in video form. It's optional, only for people who follow fiscal risk closely. Let me explain what that means. Normally, when the Fed cuts interest rates, mortgage rates go down too. That makes it easier to buy homes and stimulates the economy. But despite the Fed cutting rates multiple times last year, Treasury yields have barely budged. The 10-year Treasury yield hit 4.29% in January. That is nearly as high as it was before the rate cut started. Why? Because bond investors are demanding higher returns to compensate for the risk that America might not pay them back. The Fed is cutting, but borrowing costs are not falling. The normal tools of economic management are breaking down. Gang Inarn Bunanit, a managing director at JP Morgan and former deputy chief of staff to Yellen during her Treasury tenure, wrote an op-ed warning that the holders of U.S. debt have shifted drastically. Foreign governments used to hold more than 40% of Treasury bonds. They were reliable buyers who cared more about stability than returns. Now they hold less than 15%. The reliable block of investors that allowed America to borrow at artificially low rates is gone. Those easy times are over, he warned. Who holds America's debt now? Profit-driven private investors, hedge funds, banks, insurance companies. These buyers are far more sensitive to risk. If they start to doubt America's ability to pay, they will demand higher interest rates, or refuse to buy at all. And if they refuse to buy, the only option left is for the Federal Reserve to step in and buy the debt itself. That is monetization. That is the path to inflation crisis. Japan is the largest foreign holder of American debt at $1.1 trillion. The United Kingdom is second at $89 billion. China is third at $756 billion. Together, these three countries hold less than 8% of America's debt. A decade ago, they held much more. They have been quietly reducing their exposure. They see what is coming. Here is what Yellen said that should terrify you. Should we be concerned about the potential for fiscal dominance? In my opinion, the answer is yes. The former Fed chair, the former Treasury Secretary, the most credentialed economic policymaker in America, is saying, yes, we should be concerned, not might be concerned, should be concerned. The preconditions are clearly strengthening. And she admitted her own role in creating the situation. When she was Treasury Secretary, she called on Congress to go big with pandemic spending. She said the Fed would handle any inflation. She was wrong. Inflation hit 40-year highs. The Fed had to raise rates aggressively. And now the debt service costs from those higher rates are consuming the budget. The very policies she championed brought us to this point. The report from the Committee for a Responsible Federal Budget put it bluntly. Some form of crisis is almost inevitable. Not might happen. Almost inevitable. The only questions are what kind of crisis, when it will hit, and how severe it will be. Let me tell you what this means for you personally. If you have a mortgage, your payments could spike when you refinance because Treasury yields set the baseline for mortgage rates. If you have a retirement account, the value could crash if a financial crisis hits the bond market. If you depend on Social Security, the trust fund is already scheduled to run out in the early 2030s, at which point benefits get cut by 24%. If you work for the government or a contractor, your job is at risk when austerity measures hit. If you own a business, your customers will have less money to spend as taxes rise and benefits get cut. The dollar in your pocket is losing value every day because of inflation that the Fed cannot control, because controlling it would bankrupt the government. Your savings are being eroded, your future is being mortgaged, and the people in charge are adding trillions more to the debt while telling you everything is fine. Interest on the debt is now larger than Medicare. Read that again. The money we pay to bondholders is greater than the money we spend keeping seniors alive. By 2034, interest will reach $1.6 trillion per year. It will absorb $1 in 4 collected in individual income taxes. 1/4 of all the income tax you pay will go straight to interest payments. Not roads, not defense, not schools, interest. And here's the trap that nobody in Washington wants to talk about. The only way to reduce the debt is to either raise taxes or cut spending. But cutting spending means cutting Social Security, Medicare defense, and other programs that voters depend on. Raising taxes means hurting the economy and angering wealthy donors. Neither party is willing to do either, so they keep borrowing and the debt keeps growing and the crisis keeps getting closer. In 1992, Ross Perot ran for president on a platform of debt reduction. He got nearly 20% of the vote by showing Americans simple charts of where the money was going. The debt at that time was about $4 trillion. Today, it is nearly 10 times higher. If Perot were alive today, he would be screaming from the rooftops. But there is no Perot. There's no voice warning Americans about what is coming, just politicians of both parties adding trillions more while hoping the crisis happens on someone else's watch. The Roman Empire debased its currency for centuries before collapsing. Emperors shaved silver from coins to pay for wars and bread and circuses. Eventually, the coins became worthless. Trust evaporated. The economy disintegrated. The empire fell. Janet Yellen compared America to Rome because she sees the same pattern. We are not literally shaving coins, but we are debasing the dollar through inflation and debt. We are making promises we cannot keep. We are spending money we do not have, and eventually the bill comes due. Yellen warned that if people stop trusting the coin, everything else in the economy becomes harder to coordinate. Trust is the foundation of the entire system. Trust that the dollar will hold its value. Trust that the government will pay its debts. Trust that contracts will be honored. When that trust breaks, the system breaks with it. We are not there yet. The dollar is still the world's reserve currency. Treasury bonds are still considered safe. America can still borrow at rates that would bankrupt most countries. But the margin for error is shrinking. The buffer is gone. One major shock. A war, a pandemic, another financial crisis could push us over the edge. What can you do? First, understand that the government is not going to save you. Politicians of both parties have shown they would rather add to the debt than make hard choices. Plan accordingly. Second, diversify your assets. Do not keep everything in dollar-denominated investments. Gold, real estate, foreign currencies can all serve as hedges against dollar debasement. Third, reduce your own debt. When interest rates spike, which they will, those with debt will suffer most. Fourth, build skills and relationships that have value regardless of what happens to the economy. Human capital cannot be inflated away. And finally, pay attention. The warning signs are everywhere. Yellen is ringing the alarm. The Committee for a Responsible Federal Budget is spelling out exactly what could happen. The bond market is showing stress. Foreign governments are reducing their holdings. The debt clock is ticking. This is not a drill. This is not a theory. This is America in January 2026, staring down a $38 trillion debt that grows larger every day. The Romans thought their empire would last forever. They were wrong. Americans think their economy is too big to fail. They might be wrong too. The difference is, we have been warned. We know what is coming. The question is whether anyone will listen before it is too late. Thank you for watching. If this video helped you understand what is happening, please share it with everyone you know. Subscribe and turn on notifications because this story is developing rapidly and the next few years will be critical. The decisions made now will determine whether America avoids crisis or walks straight into one. And the more people who understand the stakes, the better chance we have of changing course. The clock is ticking. 38 trillion and counting. The point of no return may already be behind us. But until the crisis actually hits, there is still time to prepare. Use that time wisely because when the bill comes due, it will come for all of us. Let me give you some additional context that makes this situation even more urgent. The 43-day government shutdown that started fiscal year 2026 on October 1st, 2025 was the longest in American history. It happened because Congress could not agree on spending levels. Federal workers went without pay, contractors lost income, essential services were disrupted. And what was it all about? Not reducing the debt, just disagreements about how to divide up the borrowed money. That is the level of dysfunction we are dealing with. During that shutdown, the national debt kept growing, interest payments kept accumulating, the financial markets kept watching. And when it finally ended, nothing fundamental had changed. The same spending levels, the same deficit trajectory, the same path toward crisis. The shutdown was a preview of the political paralysis that will make solving this problem nearly impossible. Meanwhile, the Federal Reserve is in an impossible position. Inflation remains above the 2% target. The labor market is weak, with unemployment at a 4-year high. Normally, the Fed would cut rates to stimulate the economy, but cutting rates when inflation is elevated risks making inflation worse. The Fed knows that its independence is under assault from the Trump administration, which has repeatedly called for lower rates to reduce debt servicing costs. Fed Chairman Jay Powell's term expires in May 2026. Trump has made clear he wants a successor who will be more accommodating. If the Fed loses its independence, if it starts setting rates based on what the Treasury wants rather than what the economy needs, that is the definition of fiscal dominance. That is when the debt takes control of monetary policy. And once that happens, there's no going back. The 10-year Treasury yield is the most important number in finance. It sets the baseline for mortgage rates, corporate borrowing costs, and investment decisions throughout the economy. In January, it spiked to 4.29% despite Fed rate cuts. Bond analysts warned of yield shock and the reemergence of bond vigilantes investors who punish fiscal irresponsibility by demanding higher rates. The term bond vigilantes was coined in the 1980s to describe investors who sold government bonds when they thought fiscal policy was irresponsible, forcing rates higher and disciplining politicians. For decades, the vigilantes seemed to disappear as central banks kept rates artificially low. Now they are back, and they are watching America's debt trajectory with growing alarm. Apollo chief economist Torsten Sulak pointed out that corporate bond issuance is also surging as companies race to fund AI investments in data centers. He estimated that investment-grade debt issuance could reach $2.25 trillion this year. All that corporate borrowing competes with Treasury borrowing for investor dollars. If investors prefer corporate bonds to Treasury bonds, the government has to offer higher rates to attract buyers. That pushes up borrowing costs across the entire economy. The housing market is already feeling the impact. Mortgage rates remain elevated despite Fed cuts. First-time home buyers are locked out. Existing homeowners refuse to sell because they do not want to give up their low-rate mortgages from a few years ago. The housing market is frozen, and it will stay frozen as long as Treasury yields remain high, which they will as long as the debt keeps growing. Student loan borrowers are also suffering. Interest rates on federal student loans are tied to Treasury yields. Higher yields mean higher rates for students. The burden of student debt, which already exceeds $1.7 trillion, will only grow heavier. Small businesses that need to borrow to invest and grow face higher costs, too. Many will simply not be able to access affordable credit. That means less hiring, less expansion, less innovation. The dynamism of the American economy depends on affordable capital, and affordable capital is becoming a thing of the past. The wealth transfer is already happening. Every dollar the government pays in interest goes to someone. Mostly it goes to wealthy investors who own bonds. 1/3 goes to foreign holders, including foreign governments. The middle class and poor who depend on government programs funded by borrowing get squeezed while bondholders get paid. This is not sustainable politically or economically. Mitt Romney, the former Republican presidential nominee and recently retired senator, has had a change of heart. In a New York Times opinion piece in late December, he wrote that the growing debt requires tax increases on the ultra-wealthy. This from a man who built his career on tax cuts. I believe in free markets, Romney wrote, but we have reached a point where the combination of solutions will require the wealthiest Americans to contribute more. When Mitt Romney is calling for tax increases on the rich, the situation is serious. The Congressional Budget Office recently updated its population projections. They were reduced because of the loss of immigration under Trump administration policies. Fewer immigrants means fewer workers paying into Social Security and Medicare. The Social Security cliff, when benefits have to be cut because revenue cannot cover costs, has moved closer. Previous estimates said 2034. Now it could be as early as 2030. That is 4 years away. Many Americans have already started claiming Social Security benefits early out of fear that the program will not be there when they reach full retirement age. That early claiming reduces their lifetime benefits, but they would rather take reduced benefits now than risk getting nothing later. That is the level of anxiety Americans are feeling about the fiscal future. The defense implications are also severe. Richard Huss, the president of the Council on Foreign Relations, warned that the $38 trillion debt poses a threat to national security. When you spend $1 trillion a year on interest, that is $1 trillion, you cannot spend on ships, planes, missiles, and troops. Our adversaries know this. They see America's fiscal weakness as strategic opportunity. China, in particular, has been studying the fall of the Soviet Union, which collapsed in large part because it could not sustain military spending against a wealthier adversary. Now, the tables are turning. China's debt levels are also high, but its economy is still growing and its military spending is increasing as a share of GDP. America's military advantage is eroding not because of Chinese strength, but because of American fiscal weakness. The petrodollar system, which has underpinned American financial hegemony since the 1970s, is also under pressure. Saudi Arabia has signaled willingness to accept Chinese yuan for oil sales. Russia already conducts most of its trade in yuan and rubles. Even France has conducted transactions in yuan. Every crack in dollar dominance reduces America's ability to borrow cheaply because demand for dollars declines. Central banks around the world are buying gold at record rates, 60 tons per month compared to 17 tons before 2022. They are diversifying away from dollar assets. They are hedging against the possibility that America cannot manage its debt. That hedging becomes self-fulfilling as reduced demand for dollars pushes up interest rates. The Committee for a Responsible Federal Budget concluded its report with a warning that applies to every American. A fiscal crisis does not require a single tipping point. It can be sparked by a recession, a poor Treasury auction, a breach of the debt limit, or simply a gradual loss of confidence. The triggers are unpredictable, but the underlying vulnerability is clear. America is living beyond its means and has been for decades. The bill is coming due. I want to leave you with the words of Eric Leeper, the former Fed economist. America always does the right thing after exhausting every other option, he said, quoting the adage attributed to Winston Churchill. Until that faith really gets shattered, we are okay. But if that starts to get shattered, then we are really in deep trouble. The faith is starting to crack, the warning signs are flashing, the time to act is now. Not next year, not next administration, now. Because once fiscal dominance takes hold, once the debt controls monetary policy instead of the other way around, the options narrow dramatically. Inflate the debt away and destroy savings. Default and destroy the financial system. Impose crushing austerity and destroy the economy, or watch living standards slowly erode for a generation like Japan has experienced. None of these are good outcomes. All of them are possible if we stay on the current path. $38 trillion, $1 trillion in annual interest. 120% of GDP. One big, beautiful bill adding trillions more. A Fed that cannot raise rates without bankrupting the government. Foreign investors fleeing. Bond vigilantes returning. 6 types of fiscal crisis looming. And politicians who think they will be rewarded for making it worse. This is America in January 2026. Janet Yellen warned you. The Committee for a Responsible Federal Budget warned you. I'm warning you. The question is what you will do with this information because the clock is ticking and the time to prepare is running out. Thank you for watching. Share this video, subscribe for updates, and prepare for what is coming. Because ready or not, the fiscal reckoning is on its way.